Compounding looks safest on the smooth part of the chart. Money goes in, time passes, and the line slowly bends upward. But the real test is not the part where everything is calm. The real test is the day the line drops hard, your account is bright red, and real life still asks for cash. That's when most people discover something uncomfortable. The crash itself is not the only danger. The bigger danger is interrupting the system at the exact moment the system needs time. Selling, stopping, guessing, waiting for the perfect bottom, or needing the money because there was no cash buffer. So this video is not about predicting the next crash. It's about one question. What has to be in place before the crash so compounding is protected instead of interrupted? Hi, I'm Matthew. I make finance simple. Whether you're looking to grow your wealth, understand investing, or just make smarter financial decisions, you're in the right place. Hit subscribe so you don't miss future videos, and if you enjoy this one, give it a comment and thumbs up. It really helps the channel. Start with the math nobody feels until it hurts. Imagine Matthew invests $10,000. In the first year, it grows by 10%, so now it's $11,000. In the second year, it grows by another 10%, so now it's $12,100. That's the nice, clean compounding story everyone likes to show. Then the market falls 40%. Matthew doesn't go back to $10,000. He goes to $7,260. And to get from $7,260 back to $12,100, he doesn't need a 40% gain. He needs roughly a 67% gain. That's the first turn. Losses don't just move the line down, they shrink the base that every future gain has to rebuild from. Now, a market drop by itself is not the same thing as failure. If Matthew stays invested, keeps his plan alive, and has time, the decline may still be temporary. But if he sells after the drop, or stops contributing for years, or drains the account because cash ran out, the temporary decline becomes a permanent interruption. That's why the same market crash can create two very different stories. One investor sees a painful temporary mark on the account. Another investor turns that mark into the new starting point by selling. Same chart, same red number, different ending. The difference is not bravery, it's whether the plan has enough protection to survive the moment. Time is the ingredient compounding needs most, but time only helps if the money gets to stay in the game. That's why a crash preparation video should not begin with "what should I buy?" It should begin with "what could force me out?" This is why crash preparation is really compounding protection. The goal is not to be the genius who calls the bottom, the goal is to keep the machine from shutting off. The next piece is expectation. A stock market correction is commonly described as a fall of about 10% from a recent high. A bear market is commonly described as a fall of about 20%. Deeper collapses are less common, but they happen. The point is not the exact label. The point is that drops are part of long-term investing, not a weird glitch in the system. That matters because people treat crashes like surprise exams. But if you invest for decades, the better assumption is that a few ugly tests are already on the calendar, you just don't know the date. And when the date arrives, the market is not the only thing moving. Your bills keep moving too. This is the useful planning assumption. You don't need to know whether the next ugly decline is 6 months away, 3 years away, or much later. You just need to build a system that doesn't require calm markets to function. If the system only works while prices rise, it's not a system, it's a mood. That's why long-term can't stay as a slogan. Long-term has to survive short-term pressure. The mortgage or rent still arrives monthly, insurance still arrives, food still arrives, the car still breaks. A portfolio can wait for a recovery only if the household around it can also wait. This is where the normal advice starts to sound too easy. Just stay invested is a great sentence when nothing else is happening. It's much harder when the portfolio is down, your employer is cutting hours, the car needs repairs, and the money you thought was long-term suddenly looks like the easiest cash in the house. So the real enemy is not only panic selling, it's forced selling. Panic selling is when fear makes the decision. Forced selling is when life makes the decision for you. No cash buffer, no room, no pause, no better option. That's why it's too easy to judge the person who sells at the bottom. Sometimes they made a bad emotional call. Sometimes they had a liquidity problem dressed up as an investing problem. The account was supposed to be long-term, but the household had no short-term wall around it. FINRA's Financial Foundations guidance says many planners suggest an emergency fund with 3 to 6 months of living expenses kept somewhere liquid and accessible. That's not exciting. Nobody brags about a savings account at dinner. But in a crash, that boring account can be the thing that stops the investment account from becoming the emergency fund. If Matthew's basic monthly expenses are $4,000, then 3 months is $12,000, 6 months is $24,000. Those numbers won't make him rich by themselves. Their job is different. Their job is to buy time, so a medical bill or job gap doesn't force him to sell long-term investments after they already dropped. The cash buffer also needs the right job description. It isn't the money trying to grow the fastest. It isn't the money chasing the highest possible return. This is the money that stays boring, accessible, and separate so the investment money can stay invested. In a crash, boring can be a feature. That's the first protection layer. Cash is not the exciting part of compounding, it's the shield around it. And once that shield exists, the next question changes from how do I avoid the crash to how do I keep buying when the crash feels wrong. FINRA describes dollar cost averaging as investing equal portions at regular intervals no matter what the market is doing. The advantage is not that it magically beats every other strategy, it doesn't. The advantage is that it turns a repeated emotional decision into a pre-built system. Use a simple example. Matthew invests $200 a month. If shares cost $20, he buys 10 shares. If the price falls to $10, the same $200 buys 20 shares. If the price moves back to $15, the same $200 buys about 13 shares. Across those 3 months, he invested $600 and bought about 43 shares. If the price had stayed at $20 the whole time, $600 would have bought 30 shares. In this simple example, the falling price lets the same cash buy more ownership. That's the part people understand in theory and resist in real life. Lower prices look like a sale only after you feel safe. During a crash, they usually look like a warning. And this needs a caution label. Dollar cost averaging is not a guarantee. If the market rises steadily, investing earlier can sometimes do better than spreading money out. The reason regular investing helps many ordinary investors is more practical. Paychecks arrive over time, fear arrives suddenly, and the schedule keeps the decision from being remade every month. That's why automation matters. When the screen is red, your brain doesn't calmly say, "Great, discounted future compounding." It says, "Stop the bleeding." Automation doesn't remove fear, it just means fear has to work harder to cancel the plan. This is the second protection layer. Decide the amount while you're calm, decide the schedule while you're calm, decide where it goes while you're calm. Then when the market falls, the system is already doing the boring job you wanted it to do. Think of automation as removing one bottleneck. Without it, every month has to pass through the same emotional gate. Does this feel safe right now? With it, the default answer has already been chosen. The viewer can still adjust the plan when life truly changes, but the market's bad mood doesn't get a vote every payday. But automation is not enough on its own. You can automate into something too concentrated. You can keep buying an allocation that no longer matches your life. You can watch one hot sector carry the whole account up, then watch it carry the whole account down. Investor.gov defines diversification as spreading money among different investments, so trouble in one area may be balanced by other parts of the portfolio. That doesn't mean losses disappear, it means no single bet should be allowed to decide the whole future. Investor.gov also describes asset allocation as dividing investments among categories like stocks, bonds, and cash or cash equivalents. The exact mix is personal. Age matters, time horizon matters, risk tolerance matters, but the principle is simple. Your future should not depend on one company, one sector, one country, or one good story staying good forever. Concentration feels brilliant during the good years. That's what makes it dangerous. When one part of the market keeps winning, moving money away from it can feel like punishment. But diversification is not designed to feel clever during the party. It's designed to keep the party from becoming the entire plan. The simplest way to think about it, a pyramid of dependence. The broader base carries the future, the narrower bets sit higher up. If the whole pyramid is upside down, with one exciting idea holding everything else, the account may look impressive until the one idea stops cooperating. This is where rebalancing fits. Rebalancing means bringing the portfolio back toward the mix you already chose. Sometimes that means trimming what grew a lot, sometimes it means buying more of what fell. The key is that it follows a rule instead of a mood. Maybe the rule is based on a calendar, maybe it's based on how far an allocation drifts from its target. The exact rule is something a viewer has to fit to their own situation, but the purpose is universal enough to understand. You don't want the loudest part of the market to quietly become the boss of your whole account. That's why these pieces can't be treated as separate tips. Cash, automatic investing, diversification, and rebalancing all protect the same loop. Cash keeps emergencies from reaching the portfolio. Automation keeps contributions from depending on confidence. Diversification keeps one bad area from owning the whole story. Rebalancing keeps the original plan from drifting into a different plan. Now notice the pattern. The cash buffer protects Matthew from forced selling, automation protects him from freezing, diversification protects him from one big bet, rebalancing protects him from drift. But one more layer is still left, and it might be the most boring one. He needs the plan written down before the red screen arrives. Not because a document has magic in it, because fear has a way of rewriting your memory. In calm times, you say, I know markets fall. In the crash, the same sentence becomes, maybe this time is different. The written plan also separates a real reason from a panic excuse. A real reason might be a changed goal, a changed time horizon, a true cash need, or a risk level that was never honest. A panic excuse sounds like, I will get back in later, when later has no rule attached to it. Behavioral finance has a simple lesson here. Losses often feel more powerful than gains. You don't need a textbook to prove that to yourself. Think about how quickly a $1,000 loss can ruin your mood compared with how quietly a $1,000 gain can pass through the day. The pain is louder. So the written plan has one job. It outranks the feeling. It says what you own and why. It says how much cash protects the account. It says what amount gets invested on schedule. It says when you rebalance. It says what would actually justify selling and what would only be panic dressed up as caution. Here's the audit version. Before a crash, build the cash buffer and write the rules. During a crash, follow the contribution schedule and avoid turning headlines into portfolio instructions. After a crash, review the plan when you're calm, not while the account color is choosing your mood. That gives the viewer a practical crash test. Ask 4 questions before the market scares you. 1. If income stopped for a while, would I have cash before I had to touch investments? 2. If prices dropped, would my investing still happen without a fresh emotional vote? 3. Is my portfolio spread widely enough that one story can't wreck the whole plan? 4. Have I written down what I will do before fear starts negotiating? That's the framework in one page. Write the cash number, write the automatic amount, write the broad allocation, write the rebalance trigger, write the selling rule. If one line is blank, that line is the weak spot, not because the viewer failed, but because the plan found the leak before the crash did. Keep that page somewhere easy to find, because the plan you can actually see is harder to negotiate with when the headlines get loud. This also keeps the promise honest. A crash doesn't become good just because someone says buy the dip. A crash becomes survivable when the system still works through it. If markets rise, the plan keeps investing. If markets fall, the plan has a job. Either way, the viewer is no longer building around a prediction. One final audit. If a plan needs you to be calm, flush with cash, and perfectly informed to survive a bad month, it's not finished. A stronger plan assumes the opposite. You might feel scared, the headlines might be awful, a real expense might show up, the account might look wrong. The test is whether the next action is already defined before all of that arrives. If the answer is no, the problem is not that the viewer is doomed, the problem is that the system still has a leak, and leaks are easier to fix before the storm. A crash doesn't automatically make anyone richer, it only helps the person whose plan keeps them solvent, invested, diversified, and calm enough to follow rules written before fear entered the room. That's the real framework and the real promise of crash preparation. Not perfect timing, not perfect courage, not a secret button, just fewer ways for compounding to get interrupted when the chart stops looking friendly. That's the difference the viewer can actually control before panic arrives. This video is for education, not personal financial advice. If it helped, like the video, comment with the part of your crash plan you want to check first, and subscribe for more plain English financial breakdowns. Thanks.